Inflation is the biggest problem for interest rates these days, and this week brought two reports that pushed rates higher. The Consumer Price Index, CPI, the first of the two reports, is a well-known source of drama for financial markets in the past few years. Rates are so sensitive to CPI these days that it took only a small deviation from expectations to push mortgage rates to the highest levels in 2 months. The other report is the Producer Price Index, PPI. Despite being released by the same agency, this report hasn't had remotely as much of an impact over the past few years. That began to change in late 2023 as PPI surged sharply lower, helping to build a case for inflation calming down. This week's release was the latest example of PPI getting the market's attention, but not because it built a case for lower inflation. In fact, it added a bit of insult to the already large injury done by CPI 3 days earlier. To be clear, the 2024 uptrend in rates would have been intact with or without PPI. It didn't move the needle enough to make things much worse, and it certainly could not have moved the needle very far in the opposite direction. Markets are closed on Monday for President's Day. Have a great long weekend, and that was your Mortgage Minute.